So good morning, good afternoon, good evening, wherever you are. I am Sara Longo, an assistant professor in accounting at the Free University of Bolzano from Italy. So welcome to a new webinar of the Accounting Design Project organized by Steven and Jung. And we are really excited to have you here. Today, this session has a longer duration until 11. Indeed, 2 papers will be presented. The first one is Machine Learning in Fundamental Analysis. The presenter is Haifeng Yu from Hong Kong University of Science and Technology. At 10:15, another paper, What can analysts learn from artificial intelligence about fundamental analysis? And the presenter is Oliver Binns from INSEAD. So this extended event includes both papers for making possible a collaborative discussion about how machine learning technique enhance our understanding of fundamental analysis. So before starting, for all the participants, I want to recall that during the presentation, feel free to share your videos and mute your voices. If you have questions, raise your hand by typing question in the chat box or using the raise hand function. I will call you. Please give finally the presenters the first 5 minutes uninterrupted time. So, all right, Haifeng, we are with you. Please, you can start.
Okay, so let me share my screen first. Okay, thanks, Sarah, for the introduction, and thanks to Ion and Steve for the invitation to present our paper. So this is a project co-authored with my PhD student, Kai Cao, who is also in the Zoom meeting. So this paper is about fundamental analysis via machine learning. Then this is a very new and exciting area. And a paper is quite new. So I look forward to the comments from the audience. So first, some motivation. So we look at earning forecasting in this paper. So we believe earning forecasting is very important for not only academics, but also for investors. So from academic perspective, expectation about future earning is a very important input of determinants of security valuation. And understanding the relationship between historical accounting number and future earning can help us understand the valuation role of accounting information. And there's also very large literature in accounting infer the implied cost of capital using a certain proxy for future earning expectation and stock prices. From investor perspective, forecasting future fundamental using the past financial information is one of the most important tasks in fundamental analysis and also equity valuation. Right? But even up to now, it still seems to be an unsettled issue whether it's add value to consider detailed financial statement information in forecast future earning, or simply you can just rely on the current reported earning number. So the early study mostly adopts a time series model, some certain kind of ARIMA model. That literature find the time series model-based earning forecast does not seem to outperform the simple random walk. And later on, some research by Fairfield, Sweeney, and Young in 1999, and also perhaps Fairfield and Young 2001. They look at disaggregation of earning into, for example, the component of earning or decompose profitability into using DuPont analysis into account asset turnover ratio and profit margin, etc. They find it sometimes improve the forecast of 1 year ahead profitability. But recent studies, as summarized in a paper by Monahan 2018, find actually the recent study mostly adopts the panel data approach, which takes into consideration of more accounting information, fail to substantially outperform the random walk model either. And taken at a face value, as Monahan suggested. So this result suggests a firm's current earning is the best predictor of future earning. And in the context of forecast earning, it almost implies that it doesn't add much value at all to consider detailed financial statements. You can simply just use the current earning. So this kind of conclusion seems to be quite absurd, right? Regarding the best practice. We have a large profession of financial analysts who take into a lot of accounting information to forecast future earning. And it's almost impossible, like to draw the conclusion that, you know, detailed financial statement information is useless in forecasting. So our objective in this paper is to shed light on the usefulness of financial statement information in forecasting earning and in fundamental analysis, and more broadly in equity valuation, by checking the whether machine learning algorithms, which supposed to be a more sophisticated set of statistical learning tools, can extract more useful information from financial statement outline items and generate better earnings forecasts. So we evaluate those forecasts on several dimensions. We look at not only just forecast accuracy, which most of price study focus on. We also look at information content of those forecasts generated from the different models. And we also examine their proximity to the market expectation. And also, we want to understand what are the potential reasons or contributing factor to the difference in performance, and whether the difference in performance are statistically and are economically significant as well. So that's the objectives.
I think.
Yeah, sure.
Sorry for interrupting you. There is a question by Stephen.
Hi, Feng. I want to take exception about your statement that the detailed financial statement analysis doesn't give you anything. Yes, it is true, from going back from Ball and Watts, I think 1972, the best model on average, given earnings alone, is the random walk, so called, okay? But lots of papers showed as soon as you expand that information set beyond the earnings, you get ready predictability. There's a paper by Freeman, Olson, and Penman in 1982 that says, just bring in book value and you improve your prediction. The earnings are high relative to book value, they'll be lower next period in expectation. Owen Penman paper brought in many financial statement variables to show the improvement is there. So your starting point here is not quite right. Detailed financial statement analysis does give you prediction. So I think what you're doing here is saying, I'm going to do it just a different way. Basically, they've used OLS and so as the methodology, okay?
Right.
So I don't want you to claim that you've actually sort of discovered that financial statement detail predicts returns. I think you're going to show that financial statement analysis using machine learning, you get improvement as a methodology for doing it.
Yeah, so thanks for the comments. So I agree. There is some, as you summarized, quite a few papers looking at, you know, the detail, even at book value, it helps, right? So I think our motivation is more like along the line of a recent study, like especially summarized in Monahan's survey paper. So some of the paper you mentioned, some of the slide you just mentioned, the conclusion sometimes are drawn based on in-sample kind of regression, right? So if you look at in-sample regression, of course, you know, book value and loaded incrementally to earning, etc., right? But the result, as we'll also see, for our sample forecast, even sometimes in sample you see it's low statistically significant, but if you do out of sample forecasting, it does not seem to help that much. And we're gonna see some example models, but I agree with you, right? So mainly in this paper, we show the improvement relative to some of the extant models, and also we see the improvement of nonlinear machine learning models relative to the simple OS. So that's a key result. But so how to motivate this, again, you know, that's I can think a bit more about this. Okay, thanks. Okay, so let me first summarize the main findings. So first
Sorry, okay. Another question by Ayung.
Sure.
I just have a follow-up, kind of like clarification question from your discussion with Steve. I feel like I want to know, like, what's the goal of the fundamental analysis exercise here? Is that are you motivated to find one single summary statistics has the highest explanatory power of future earnings, or collectively we have a combination of financial statement indicators or line items that will achieve the maximum R squared? So I think potentially, follow up what Steve talked about is that the book value, adding book value increase the kind of like overall R squared, because book value actually has incremental information beyond earnings. But potentially if there's a horse race between earnings and book value, earnings still has a relatively higher R squared. So I think my clarifying question is, what's the goal you try to accomplish here? Is a combination of financial statement line items to maximize the explanatory power, or picking one single summary statistics that has the highest relative to all the other indicators from the financial statement?
So yeah, that's a good question. I think, like, in a value relevant study, we see, we can simply just run a regression of contemporary stock return and on various or stock price on various accounting number and see it's add incrementally to each other, right? It's useful, right? So financial statement analysis or fundamental analysis, I think it's more kind of from investors' perspective. We want to figure out valuation. We want to kind of come up with a forecast of future fundamentals, so we can come up with a value of the company, right? So in that case, to come up with certain kind of forecasts based on the historical financial statement and perhaps other information, so that is accurate enough and that is informative enough so that it can guide us in investment decision making, right? That seems to me would be the goal, right? So that's why. So we look at various dimensions, right? Not only just accuracy, right? So accuracy is not really kind of sufficient or neither sufficient or necessary kind of condition for decision usefulness. And we also look at information content, etc., right? So hopefully, like from this various different dimension, we can see like a machine learning based forecasts are useful for investment decision making, right? That's our goal, right? But I guess like different people will have different objective in terms of what is kind of usefulness, right?
Thank you.
Okay, thanks. Okay, so we find like machine learning models, especially those that accommodate non-linearities, generate significantly more accurate and informative forecasts than extant models in the literature. And the machine learning models achieve this by uncovering economically sensible relationship between historical financial information and future earnings. And the new information uncovered by machine learning models is of considerable economic significance to investors. And we show that this new information components predict future stock return and also analyst forecast errors. So let me quickly review the extent model we studied in this paper, and it's definitely not a complete list of the paper models that examined in the literature. So first is a random walk model, which is used as a benchmark for most of the extent study, which model earning as a random walk process. The second model is an AR model. Again, it's a model earning as an AR1 process, right? Very simple. The third model is we call HVZ model, developed by Ho and Van Dijk and Zhang 2012. So this model take a panel data approach. It's estimate the predict the future earning based on more financial information. The A here is a total assets, D is a dividend, DD is a dividend paying dummy, and E is historical earning. Neg E is a negative earning dummy. AC is a accrue. Right? So this is a HVZ model. The next model is SO model, which actually quite similar to the HVZ model with a few differences. The first difference is this model is estimated per share basis compared to HVZ model originally estimated on a dollar amount to the dollar amount basis. It's also separate positive earning and negative earning. For the accrue, it's also a separate positive accrue and negative accrue, allow them to have different implication about future earning. And in addition, it's also add AG, which is asset growth. NDD here is a non-dividend paying dummy. DIV is dividends. So in addition to financial statement numbers, the SO model also include two variables related to forward-looking stock prices. One is book to market ratio, and the other one is just stock price. So this allows the model to incorporate forward-looking information beyond the financial statement, and we'll see that it's actually captures some new information content relative to other models. And the last two models are developed in Lee and Muharram 2014. The first one is EP model, basically just a relaxed AR model by allowing positive and negative earning have different persistence. And the final model is a RI model, which is a residual income model, simply just adding the book value of equity, as Stephen just mentioned. The book value of equity is useful to predict future earning, and also total accrue, right? So those are the few models, extent models that we examined, and we're also going to use as a benchmark models. So by taking a quick look at the extent models, we have a few observations, right? So first is most of the extent models focus on highly aggregated financial statement items, right? So this, of course, is because that most of the extent model are grounded on economic theory. For the models derived based on economic theory, usually it's coming from, you need to have some kind of abstracts, right? So you cannot have a model can include too many moving parts, right? That it's just difficult to solve, right? So, but using this highly aggregated financial state items also gives some limitation to the model, right? Because the generation process of corporate earning is very complex. Even for among the resources company have, we have current assets, we have PP&E, and we have intangible assets. And so different asset may, for example, may have a different implication, different productivity about future earning. So, and if you aggregate them, then you may potentially lose some information, right? So a second observation is that most of extent model primarily rely on linear estimators, right? OS regressions, right? So again, linear regression OS is easy to understand. So that's why most of study adopt it, right? But the relationship between historical financial statement, line items, and future earning does not have to be linear. And actually, there's a lot of reason for us to expect to be nonlinear. So for example, this well-known law of diminishing return says if as a company invests more, the kind of marginal return to the additional dollar of investment going to decrease over time. That suggests the relationship between input and future output is linear, right? And it's not linear, right? And also there's a large literature talking about the relationship between current and future earning or current profitability and future earning should be nonlinear, right? So for that reason, I think the extent model are subject to those limitations, right? And that's exactly where machine learning algorithm could be useful, right? So because machine learning algorithms are well known to be able to handle high dimensional data better, and it can also accommodate more complex and nonlinear relationships. So in terms of machine learning models, we examine two sets of models. Right? First, we start from still linear models. We use a simple OS, but just including a richer set of financial statement line items. And because you have, we're gonna include a long list of financial statement items. You could have overfitting problem. You could have multi-collinearity problem. So we use Lasso and Reach, which can impose some parameter penalization, regularization. So that could help to mitigate the overfitting problem. So in addition to the linear machine learning models, we also look at a set of nonlinear machine learning models. So those nonlinear machine models could accommodate, the nonlinear, of course, nonlinear subtle relationships. Right? So we look at three models. First one is random forest, and second one is gradient boosting regression tree. So these two models are based on decision tree. And the third model, what we call here is artificial neural network. That's what Oliver will call deep learning models. Right? So what we do is we use a simple multi-layer perception regressor. We use a bagging approach to further reduce the overfitting risk here. So that's the 6 machine learning models we're gonna study. So here just summarize the model comparison framework. Of course, we're going to start from random walk model, which is a benchmark for everyone. And we also look at the 5 extant models, proposed by developed in the extant literature, and 3 linear models and 3 nonlinear models. So in addition to individual models, we also look at several composite models. The composite EXT is the average forecast of the 5 extant models. And now the composite LR is the average of the 3 linear models. And composite NL is the average of the 3 nonlinear models. And finally, the composite ML is the average of 6 machine learning models. So the forecasting process, first, we're gonna select certain features, which we're gonna discuss just in the next slides. So after select the features, so for each of the 45 years in our sample period, each year we used prior 10 years data to learn or to train the model using cross-validation so that we can select the best hyperparameter. And then use the learned model, we generate our sample prediction using the current year financial statements. And then we can evaluate the performance with future actual earning, right? So, and we're doing this on a rolling basis, right? So each year we're gonna be able to generate our sample earning prediction. So features or input or independent variable selection, right? So we actually have a lot of different possible choices, right? The most obvious choices is just use the raw financial statement line items. So in this paper, we rely on a set of raw financial accounting numbers as the main inputs. So we take 12 line items from income statements, which basically cover all the major line items on the income statements, and then 15 from balance sheets, right? And we only take one cash flow from operating activity from the cash flow statements. So we only take one because cash flow statements is available from like late 80s or early 90s, right? So, but our sample period go back to 65. So for early period, we just infer the cash flow from operating activity using indirect approach. So in addition to this level of financial accounting variables, we also include their respective first order difference. So because prior literature show, for example, earning difference contains some incremental information beyond the level of earning. So we also include the first order difference. So altogether, so we got 56 input features, right? So as I mentioned, in addition to, go ahead.
There is a question, Kevin, please.
Yeah, so I'm looking at the variables that you've got here selected. Yeah. I was just kind of curious because some of these are going to be pretty collinear with one another. So you take like current liabilities, long-term debt, total liabilities. And I mean, with your models, the regularization parameter is going to let you run them just fine, right? Like no matter how multi-collinear they are, they're just fine. But when you go in to do your feature interpretation, so your figure 1 and 2 in your paper, doesn't that make it completely uninterpretable? Because the multicollinearity between them is not going to give any of them like incremental predictive power. So doesn't that kind of make it hard to interpret the feature importances?
So that first, I agree that some of the financial statement items are highly correlated, but we made sure they are not perfectly multicollinear with each other. So we take out some items, so there's no perfect collinearity here. So first, and second, just related to the feature importance. So I think it will affect this more or less, but as we'll see, even with that potential multicollinearity you mentioned, right? The importance analysis we did, that we still reveal that the features that turn out to be most important, they make perfect economic sense a lot of times, right? So I guess the issue is not that severe, but I agree if we can potentially input orthogonal source of information, right, or less correlated information, that could be even better, right? That help to mitigate the overfitting or multicollinearity problem to start with, right? Okay.
I think.
Yeah, sure.
Another question by Stephen.
Sure, go ahead, please.
Oh yeah, I think, just following up on that question from Kevin. I'm not sure how much you want to go and look at each individual separately. All these financial statement variables come from a system, a double entry system where they're generated jointly. Okay, right. So we always interpret earnings and book value together, and all these other things together. Okay, inventory and sales. Okay. Right. So that's the idea of financial statement analysis, see what the system jointly gives you in terms of predictive power. So the idea that you're pursuing, you're looking at individual numbers, seems fairly arbitrary and inconsistent with that notion that financial statements are produced under a joint process, a double entry system.
Yeah, so we just threw in the major item without kind of putting the structure that you mentioned. But later on, as we'll see, we'll also try to look at whether the machine learning algorithms pick up certain interaction between the different financial statement items. Actually, what we'll see is that the machine learning algorithm also pick up exactly like what you mentioned, some the income statement that related to the balance sheet, so that the machine learning algorithm pick up some interaction between them, right? So this set of features, we don't do much. So we just kind of throw in, we just let machine learning algorithm try to do everything. We don't want to supply with knowledge from accountants, right? So
but really, one of the dangers, as I understand, I've never done it, but the machine learning is overfitting. So to the extent you can constrain the machine from wandering away, okay, you always need structure. You need structure to guide the machine. And the wonderful thing about accounting is there is structure, okay, and you can put it. A structure is to convey information. So employing that structure in your specification to constrain the machine from overfitting, I think is actually in this area is quite important. That is my guess. Okay.
Yeah. Frankly speaking, that's what that's something I wanted to. We're working on as well, right? So how to put a structure or put some constraints, right? So in machine learning models, in particular on nonlinear machine learning models, right? That's something will be. So if we can impose some structure there, and together with the power of machine learning algorithms, I think that would be the best, essentially.
Yes,
right?
Yes, I think so. Yes.
Our knowledge here, right?
Yes.
But one thing we try here is that, so instead of just directly throwing the raw accounting variable without any kind of transformation, we also try to alternative set of features, right? For example, we try the disaggregated variables or ratios like the DuPont analysis conducted by Fairfield and Young. We also so we look at the textbook by Langholm and Salon. So in the textbook, they have a systematic earning forecast framework where they identify a lot of earning drivers, like again similar to DuPont analysis, but it's kind of more, it's finer disaggregation. So identify actually 16 earning drivers ranging from, for example, current asset turnover, long-term asset turnover, and some kind of margin and profitability ratio, etc. So we use this as alternative sets of input feature as well. And also we try kind of a more data mining approach. We take the 100 top fundamental signal from Ye and Zhang. So we try all of this, but so the different alternative sets also is useful to generate reasonably good earning forecast, but the outcome is that if you look at accuracy and information content, they're not as good as just simply provide the machine learning models with the raw financial statement items, right? And this also kind of consistent with a recent paper published in Journal of Accounting Research by Ball et al. So they were looking at prediction accounting fraud. They actually find a similar thing. So compared to two cases, whether you just simply supply the model with raw accounting values versus using some accounting ratios that prior literature find is useful to predicting accounting fraud. And they actually also find using raw values is better than using ratios. In presence of raw values, throwing the accounting ratios actually does not have incremental predictability. So what we actually find in this paper is similar to what they find in that paper, right? But I agree. I'm still trying, right, how to kind of combine this machine learning with some kind of accounting knowledge or constraint, right, to generate better forecasts. I'm still working on it. Right? Hopefully, we can find some more interesting result later. Okay, so now.
So we have another question from Jung.
Sure. Go ahead, please.
I have a question about, it's more like a suggestion, it's maybe a follow-up analysis. So if you look at those line items, look at inventories, it's probably manufacturing firms have inventories, but service firms may not have inventories, right? So I feel like to help audience, or mostly an academic audience, to learn from machines, is that potentially you can run this training process by industry or by type of business.
That's another thing. That's very good suggestions. Actually, that's one thing we tried. I tried. So, and there's another puzzle that also highlighted in Monahan's paper. So, in Monahan's survey paper, he summarized some evidence. So, in the current literature, research already tried this, right? So if you do this forecasting by industry, actually you don't get more accurate forecast. This is also what we find here. We retrain a model by sector, but the outcome is that it's not better than just train one big model for all companies. I think that's, training by industry or sector certainly got a more several set of more homogeneous company, right, within the subgroup. But the cost is that you can abandon the information from other industries, which could also help to learn more fundamental relationships, right? So I think the best approach should be combine these two, right? So even if you want to have different industry to have different models, but you still don't want to just throw away all the information you can learn from the kind of the economy-wide models, right? So how to kind of combine these two sets of information. So that's something we're still working on.
So a follow-up on that is that I think you can estimate within each industry because they share homogeneous businesses, but you can also use census as input and output table about cross-industry relationships. So to kind of like to infer how certain industry
related industries
relates to other industries in the economy, and that potentially can increase. I feel like my question is less about increasing the accuracy or minimizing, but it's whether a machine picked up something that relates to fundamentals or accounting equations or certain accounting standard rules. Just more like a validation of what exactly machine picks up.
I agree, right? So if you do a more careful or analysis on industry, on certain industry, that can help kind of review kind of more maybe interesting results, right? Reflecting the underlying business of the particular industry, right? So that's something we're still working on. Yeah. Thanks.
I think we have a suggestion and a question from Pengu.
Sure, go ahead, please.
Yes, it has long been established prices lead earnings. So why don't you choose price as a predictor?
So that's
in the model. As cited in the chart box, basically, this Harrison Wang basically published a paper that they proposed the forecasting model by incorporating price as an explanatory variable. They find the forecast is more accurate than the model you just listed in your previous slides.
Yeah. So we thought about it. I mean, the reason that we don't want to include stock price, because so we feel like as an investor, if we want to do fundamental analysis, the objective is to try and find mispricing equities, right? So we want to start from the basic financial statement information. So we don't want to, so that we can get a valuation metric, for example, and we can compare to stock price to see whether it's overvalued and undervalued. We don't want to get kind of peek ahead or peek into the stock price and try to learn something, information, and then to evaluate whether stock price is overvalued and undervalued. But I agree with you, so stock price contains some information, and presumably, for example, if our sole objective to come out with the most accurate or most informative forecasts, there's tons of other information we can also potentially take into consideration. For example, analyst forecasts, right? Some other information, but currently we just kind of limit ourselves to the financial statements, right? So that we can see whether financial statement simply rely on the readily available financial statement information. Can machine learning models extract something useful, right? Can extract something useful that are not really understood by investors, by analysts, right? So that's a goal.
Right.
Okay, thanks for the question.
I think other suggestions from Jonathan?
Sure, go ahead, please.
No, they were largely along the same lines as Stephen's comments. So I think we can skip me.
Okay.
Okay. And then another suggestion by Atif.
Sure.
Yeah, I've already said what I was going to say. It's pretty clear. And I think you probably are not following the chat, so just a high-level summary. It was just a follow-up on Steve's comment about the double entry system and sort of imposing some sort of a structure.
Yeah.
There are other approaches, for example, Bayesian analysis that can incorporate some more structure and impose priors on the problem, rather than sort of comparing it to purely reduced form statistical models. So I was just curious about how this would stack up against other models that are able to learn and, incorporate non-linearities and other ways that humans might interact with the data. So it was just a suggestion.
Yeah. So we'll try work on that, and we have also been trying. We are working on that, right? So the few thing that we've been thinking about, in the machine learning area, there's a lot of exciting new development. For example, there's a multitask learning, etc. So we can try to, for example, to forecast the components and then see whether that can aggregate them together to get a better forecast. In some sense, that serve as a structure or constraint, right? But again, so at this stage, in this paper, we haven't done much, but it's certainly a very interesting and important direction. We'll definitely work more on it.
Yeah, and also from a contribution standpoint, just to follow up, I mean, there's this man versus machine aspect to it, but you've got machines against other not so good machines. I think that aspect would also help on the contribution front.
Yeah, so you can say the not so good machine, like extent model, are not so good machine, right? So, but the analysis we did that. So we look at the new information and that orthogonal to these extent models, and we demonstrate this new information that orthogonal to the extent models. Actually, this contains a tremendous amount of information that useful to predict future stock returns and analyst forecast error, right? So that presumably suggests that actually a large number of investors or even sophisticated analysts do not pick up that information, right? Uncovered by machine learning models, right? Of course, again, is this the best model we could have? Certainly not, right? But our objective is simply using the limited set of financial statement information to see how much we can go, how much further we can go, right? Of course, we can do much better, right? If our objective is to come up with the best model.
Yeah, I mean, one other thing you might think of just in this last point, you want to pit the best machine against the best human. I guess you sort of on average, yes, I agree, analysts are not that sophisticated, but you want to compare your machine to the best alternative out there, I guess. I mean, that would be
So the question would be, what would be the best alternative, right? What is the best alternative there, right? Is an aggregate market a best alternative? If you think about markets efficient, right? It's aggregate.
It's not. That's what I'm arguing. It's not. That's not the best alternative. You want to get the smartest guy in the room and compare that to the machine.
Right. So I would welcome suggestions. Right. So how we could find that benchmark, but we'll certainly be interested.
Yeah. Just adding to that. Sorry to butt in, but there's a paper by Jim Whalen and I think someone else a few years ago, looking at a detailed financial statement analysis, I think in an OLS model, showing that, you know, a very high portion of time it beats the analyst forecasts, okay? So that could be a benchmark paper for you in the sense that, you know, they're using OLS. When you're using machine learning, then you make a different comparison.
Okay, yeah, so we'll take a look at that paper, maybe like use as a alternative benchmark. Yeah, good suggestion, thanks. Okay, so now I'll just quickly go through some of the key results. First, we look at accuracy. So basically just absolute forecast error scaled by stock prices. We tried alternative scaler, so the result is all robust. So first we look at random walk model. For mean absolute forecast error is about 7.6% of market cap. And then X-type model reduced a little bit by 2 or 3% average. Actually, the SOL model, which incorporate the future stock price, is not nearly as accurate as even random walk model. For the simple reason, you know, stock price, even though it contains some useful information, but at some time it's very volatile, right? So it also contains a lot of information that unrelated to fundamentals, right? So that's why if you look, the accuracy is actually lower. And the linear machine learning models reduced the forecast error by about 6%, and nonlinear models reduced to about 9%. So you look at the composite models, we see similar results. Nonlinear X-type models reduced by about 3.5%, linear model reduced to about 6%, and nonlinear model reduced to about 10%, right? So the median forecasts, the improvement seems to be smaller. Median is always difficult to beat. So X-type model actually underperformed the random walk. Linear models improve about 1.3%. Nonlinear model improve about 5.5%. And then we look at, go ahead.
3 minutes left.
Oh, okay. I'll just quickly go through some of the results. Then we'll also look at some cross-sectional results. We find that improvement is higher for company with more volatile earnings, with high absolute magnitude of accruals, and company with more R&D expense, and company that suffer from loss. So basically, the more difficult to forecast, when in company, when earnings is more difficult to forecast, machine learning makes a big difference here. And then we try to look at picking to the black box. We look at the feature importance, and we'll try to also get a visualization of the relationship between predictors and target variables. So first we find both random forest and gradient boosting regressor, they identify the same set of the 5 most important features, right? Which is historical earning, cash flow, book value. And interestingly, both models also pick up tax expense and changing tax expense as 2 of the most important predictors. So here we plot the relationship between the important features and future earnings. Again, we find there's a lot of nonlinear relationships here. We also find some very strange relationship, right? Changing tax and future earning for 1985. That actually is because in 81, there's a major kind of tax cut in US history, and which was reversed right next year, right? So that kind of messed up the relationship, right? So for all other relationships, it seems to be reasonable, right? We'll also look at interaction effect. This is what I mentioned earlier. And we find that, you know, the interaction, the machine learning auto models also pick up some interaction effects between variables that we expect them to be related. For example, sales and cost of goods sold, changing sales and change cost of goods sold. and changing current liability and changing current debts, sales revenue and account payable, cost of goods sold and inventory, and depreciation, amortization, and PP&E, etc. So looking at information content analysis, so by information content, we mean the ability of forecast earning change to predict future actual earning change. So what we find here is that first, machine learning models, they are more correlated. The predicted earning change based on machine learning models have higher correlation with future actual earning change than extent model and then both the linear machine learning models. And this is the multivariate regression results. This is what I want to emphasize a little bit. So actually, so in presence of all the, yeah.
Can you wrap up for shifting to the paper by Oliver? Because it's 10:15.
Oh, okay. So
yeah.
Okay. So yeah. No problem. Yeah. Okay. So I'll just maybe 1 minute. So so here we basically find that in presence of the machine learning models, all extent models lost information contents, predictability. And then later on, we do the economic significance analysis. We basically just want to see whether the new information uncovered by machine learning models have any predictability on stock returns and forecast errors. We use both a regression analysis and portfolio analysis, and we find the new information component, which is earning forecast orthogonal to the extent models, has significant prediction power over both future stock returns and its forecast errors, right? So that's kind of pretty much the key result I want to emphasize. So sorry for a bit over time. So let me stop here. Thanks again for all the comments and suggestions.
Thanks to you, Haifeng. We gather also other suggestions from David Zibart, and Ayung again gave you other suggestions. So we are gathering everything and then it will send you. So now it's time to give the talk to Oliver. So Oliver, you can start and you can share your slides.
Wonderful. Thank you, Sarah. Thank you, Haifeng, for the nice presentation. And thanks so much to Ayung and to Stephen for organizing this and inviting us to present our paper here. So this is joint work with Catherine and Kevin, who are also in the audience. And in this paper, we ask, what can analysts learn from artificial intelligence about fundamental analysis? So we basically start with the key equation in accounting-based valuation, and that is the residual income model. So here we express firm value as a function of shareholder equity and future discounted residual income, where we express residual income here in the ratio form. So we compute it as ROCE minus the cost of equity multiplied by like book value of equity. So the core question in this equation is, of course, how do we forecast profitability? How should we use accounting information to forecast profitability? Which accounting information should we use? How long should we forecast profitability out in the future? And which valuation framework should we use, right? So the paper by Nissim and Penman gives us a very nice structure to do that. So as Haifeng was already discussing in his previous presentation, machine learning is extremely flexible. So having a structure like that is wonderful. And the Nissim and Penman paper is one of the state-of-the-art works in that area. So they basically split ROCE into different value drivers that then can be used to forecast our ROCE in the future. So for example, in the first split here, we look at the minority share ratio and return on common equity, on total common equity. In the next step, we account for financial leverage by splitting it into return on net operating activities and the financial leverage component. In the next step, we can also look at sales profit margin and turnovers in addition to that as predictors. And then we can also take account of operating leverage. So when Nissim and Penman tried to estimate that model using linear models such as OLS, they ran into a couple of issues here. In particular, they tried to forecast residual operating income out of sample, but these predictions generally performed pretty poorly back then. And they conjectured at that time that because a lot of these relationships between past value drivers and future profits are nonlinear, these linear models wouldn't be likely to work well. And here we have a bit of evidence that underlines the statement in Nisman-Penman. So here you see future profitability on the y-axis, and you see certain past value drivers on the x and z axis. And in a linear world, we would expect to see flat planes here. But that doesn't seem to be at all the case. We see these convex relationships, we see concave relationships, we see interactive relationships. And in this paper, we argue that OLS cannot solve that issue of estimating the Nisman-Penman framework, because let's walk through a simple example here. If we just have one dependent variable, so future profits as a dependent variable, and 10 independent variables, then a simpler regression can easily estimate that, right? So if everything is linear, we can handle that. We have one intercept and 10 slope coefficients, so we have 11 parameters. The world is still doing pretty well. However, once we have certain concave or convex relationships, so we add squares and cubes, then things start to get a bit more difficult. In that case, we have 31 parameters, and the moment we bring interaction effects in, there's no way we can estimate this with OLS anymore. We have thousands of parameters to estimate. So in this paper, we proposed a novel machine learning algorithm as a potential solution for that, and that is deep learning. Deep learning has been used recently successfully in several applications, for example, autonomous cars, natural language processing, mammography for detecting breast cancer, online advertising, and also in active investing, trying to use artificial intelligence to identify undervalued firms. So deep learning is what Haifeng already mentioned, a special case of a neural network algorithm. And in a neural network algorithm, typically we have multiple layers of latent variables, so-called neurons, that we link linearly with each other. And I will explain that a little bit more on the next slide. So it turns out that these structures automatically estimate nonlinearities across variables, and that also that these structures can approximate arbitrarily complex relation. In particular, Hornig et al. 1989 have shown that these structures can literally approximate anything. They're extremely flexible, again, highlighting the importance of having a structure that we estimated on. And advances in computing power recently have made estimation feasible. So it turns out it's computationally fairly expensive to estimate these algorithms, but recently chips have become so fast that we can now handle them. And so here you see a little bit the population of different, the popularity of different machine learning algorithms over time and why we chose to go with the deep learning algorithm. So the red line you see here is a Google trend search for neural networks. So neural networks were pretty popular already in the early 2000s, but because of computational issues, they lost popularity over time. But recently, since we started using GPUs, which made the computation of these networks feasible, they have risen in popularity again. And here we also have the popularity of some other machine learning algorithms that we've already seen in use in accounting, lasso regressions and random forest regressions. So they also have increasing popularity recently. But the big star of the show here, which appears to be used most now in the industry, is indeed these deep learning algorithms, again, justifying our choice for this particular machine learning algorithm to estimate the Nisman-Penman structural framework. So just to explain you a little bit what these algorithms do, so you can think of a very simple model as the Watson-Leftwich random walk model. So in this case, we have one dependent variable and one independent variable, and they are linearly linked, right? So in this case, the dependent variable is future earnings, and the independent variable is lagged earnings. In another structure that gets a bit more complicated, we might have multiple predictors. So for example, in the Hu et al. 2012 model, we generally have multiple independent variables that then predict one dependent variable, where the dependent variable is again typically future earnings, and the independent variables are, for example, book to market ratios, the indicator that we are paying a dividend, lagged earnings, accruals, and so forth. And these are all linearly linked. So far we are very familiar with these structures in the current accounting literature. The next step then is what is called a shallow neural network. So in this case, we introduce an additional layer between the independent variables and the dependent variable, and we link the latent variables in this hidden layer, this additional middle layer with these latent variables linearly to the independent variables and the dependent variables. And it turns out that this structure can already approximate arbitrarily complex relationships. The next step then would be a deep neural network where we have multiple of these hidden layers. And recently, research has found that this structure is even more efficient. So while the shallow neural network can already approximate everything once we have enough data, these deep neural networks do better and are more efficient in estimating these nonlinear relationships. And in addition to that, we can have multiple dependent variables. So we can forecast multiple leads of profits at the same time, which has the benefit that these individual profit forecasting models might learn from each other and enhance the overall model performance. So we choose the following research design to try to get as close to fundamental analysis as it's done in practice as possible. So we take the perspective of an equity investor who seeks to maximize risk-adjusted returns. And we take the following, we take the typical steps of fundamental analysis. So first, we use our deep learning models to forecast profitability, either ROCE or RNOA. In the next step then, we use a valuation model, such as the residual income model or the economic value added model, to derive a value estimate given these forecasts. In the third step then, we form hedge portfolios based on these value to price ratios. We go long in stocks that have high value relative to their price and short in stocks that have low value relative to their price. And then we calculate the Carhart four-factor model alphas according to that to evaluate their performance, which brings the benefit that we can evaluate the performance of ROCE relative to RNOA-based models at the same time. So while it's difficult to compare absolute forecast error across ROCE and RNOA-based models because they have different scale, alphas can capture that difference. And here you see a little bit the timeline of our model estimation. So we go through lengths here to make sure that we do not have any look ahead bias in our estimation. So all the forecasts that we will see here are out of sample. And then lastly, and this is the core part of our paper, we take these model alphas and regress them on different financial statement analysis design choices that went into as the model inputs, so that we can derive, for example, advice to financial analysis, to financial analysts to make better financial statement analysis design decisions. And here are the particular decisions that we examine. So which design choices affect performance? The first one is, of course, one of the core parts in the Nisman-Penman model, and that is the level of forecast disaggregation. So here we have the different levels, level 0, level 1, level 2, level 3. Level 1 and level 2, we start incorporating this difference between financing and operating. And level 3, we start thinking about turnovers and profit margins. And level 4, we start thinking about operating leverage. So the question is it always better when we use more disaggregated information? On the one hand, if that information is really valuable, yes, then it should improve our model performance. On the other hand, if that information behaves more like noise, then actually it might hurt our out of sample performance. In the next step, we also check whether focusing on core items relative to non-core items helps our model performance. So managers generally classify certain income statement items, for example, in core and non-core components. And typically in non-core components, we see things such as restructuring charges or discontinued operations. But at the same time, we know from Sarah McVeigh's dissertation that there is potentially shifting going on from items that are actually core into these non-core categories. So the question is, when we leave these items out, are we potentially missing out on valuable information? The next question we examine is when we focus on operating activities rather than focusing on operating and financing activities jointly. So on the one hand, we have the classical residual income model, where we just estimate value as book value plus discounted residual income plus a terminal value. On the other hand, we have sometimes it's called economic value added model, where we value the operations as a whole rather than just equity, and then subtract out the fair value of the debt from the books to arrive at the value of equity. So which one of those does better, an ROCE-based model or an RNOA-based model? The next step, we also check something where we don't have a lot of empirical evidence yet for in the literature. So how does it help us when we expand our forecast horizon? So should we, how far in the future should we forecast? That's just generally something we teach our students in financial statement analysis classes, forecast as long as possible, but we don't have a lot of empirical evidence on that yet. So we are hoping to provide a little bit of evidence within our study. And then lastly, we also think about historical data usage. That is, for our analysis, should we focus on the current period financial statements, or should we also take the financial statements from last year, from the last 3 years, or the last 5 years into account? And that again goes to this idea of whether that additional information provides information to us, and thereby improves our performance, or whether the current information reflects already all relevant information, and using at old data here, at old financial statement data, would just provide noise and thereby hurt actually our performance. So let me start with the profit forecasting results. So that's where our valuations later are based on. So here you see the absolute, the mean ROCE absolute forecast errors for different models. So for example, the first one here you see in the upper left corner, you see the absolute, you see in the mean absolute forecast error for a model that forecasts 1 year out, only uses the current period financial statements, does not focus on core items, and uses a level 1 forecast disaggregation. And what these little crosses mean is that the model has a lower mean absolute forecast error than, for example, the random walk, which in Steve's review about the earnings forecasting literature that he published in 2018, I think, he has classified that as kind of the benchmark model there is to beat right now. Just the random walk, because it turns out that a lot of these more complex models, such as the Hu et al. Model, for example, actually underperform the underperform this simple random walk model when we look at out of sample forecasting performance.
Oliver, we have a question from Ayung.
Oh, please, Ayung.
Oliver, I really like that 2 slides before when you talk about that you are going to test different kind of measurement issues, whether it's a core items or different model. And then there are 2 thoughts as for your consideration. One is you can actually consider accounting numbers that reflects managers' estimates versus accounting numbers that mainly reflects realized transactions. So think about cash sales versus credit sales. So accounts receivable has more estimates versus some of the cash sales numbers will be more kind of like realized physical transactions that have occurred in the past. And that potentially can tell us a little bit about different quality or predictability of accounting numbers. The other thought is fair value numbers versus historical cost numbers, right? That some of the line items is measured based on different bases. And me as personally would be curious to see how that relates to future profitability.
Yeah, great suggestions. Thanks so much, Ayung. Would you frame those also in the Nisman-Penman framework, or would you use them as separate predictors? Because right now we kind of focus our analysis around that structure.
Yeah, I feel like those are will be the extended. So like if they have 5 layers, this will be like further down 6 or 7 layers within each, for example, core operating RA or profit margin line items, and then eventually they are different measurement bases or different level of the managerial estimation.
Yeah, I like that idea. So we could basically extend that structural framework so that we maintain the structure while incorporating these additional predictors. Thank you. I appreciate that. Okay. Then we also have here the mean RNOA absolute forecast errors. And similar to what we've seen for RCA, we see that in general, our models outperform the random walk. So, but I think the core of our analysis is really in these hedge portfolio results, because that's where we can draw inferences for financial statement analysis and can also directly compare RNOA versus RCE based models. So here we just, we basically give you the raw data that we put later in our analysis. So here we have our RCE based alphas for all the different models, which are all shown here in the paper. So there we generally see, for example, again, we have here a model in the upper left corner that is not based on core items. So it doesn't focus on core items. It has a level 1 disaggregation. It forecasts 1 year ahead, and it does not use any historical information. And then on the other hand, when you go to the lower right corner, you have the more complex models. So for example, here you have a model that focuses on core items, uses a level 3 forecast disaggregation, and forecasts 10 years ahead and uses 3 lakhs of financial statement data. So in general, we see that while the alphas are generally not that large when we use RSE-based alphas, we see that alphas tend to increase here from the upper left to the lower right corner, but the results are not very strong. So things turn out to be a bit different once we turn to RNOA-based alphas. So here we have some interesting results. So when we have RNOA-based models or economic value-added models, we see extremely poor performance when we only forecast 1 lead out. But that changes dramatically once we expand our forecast horizon. So once we look at models that forecast 5 years ahead or 10 years ahead, we have very strong performance. So the challenge, of course, with what I've shown you so far is very difficult to interpret these results because we look at everything at once rather than trying to isolate individual value drivers. So to really understand how a different financial statement analysis design choice affects our performance, we should look at them holding all the others constant, right? And we can do that, of course, with our typical regression models. And that's exactly what we do here, starting the next slide. So what you see here is now an estimation of taking exactly these alphas that I've shown you in the previous 2 slides. We take those as data points, and then we regress them on different financial statement analysis design choice indicators. And we regress them on all of these different financial statement indicator analysis design choices jointly. However, I will show them to you piece by piece just to facilitate presentation so that it's easier to understand. But please note that all these regressions include all the financial statement analysis indicators. So to get as much out of the information that I showed you on the previous 2 slides as possible, we not only look at OLS regressions, we also look at quantile regressions. So OLS generally, yeah, please.
Oliver, sorry for interrupting you. We have the first question from Steve, then Steven, and finally also Kevin. So please.
Awesome.
So hi, Oliver. Mine are very quick. They're just sort of clarification questions. Regarding your forecast errors for your ROE and RNOA, something that I'm just curious about is what exactly are those forecast errors of? Like, is that a 10% error means that RNOA was 20% and you forecasted it to be 10%?
Yeah, exactly.
Okay. And then something that's interesting about those is you'll notice that they don't really scale with the forecast horizon, which is a little bit surprising. You would expect that you would get worse as the forecast horizon goes out. That's just a comment. And then the second thing I just wanted to ask was if you could aggregate your forecast errors over the horizon, how do you think they would correlate with your alphas?
Yeah, so we worked a little bit on that. And in general, we find that our models that have low forecast errors also yield higher alpha. So it seems like they kind of align with each other pretty well.
I would make a bigger point of that because I think that's crucial to getting around the issues that people might go after you with returns different growth rates for different firms because you assume they're constant. Yeah. And also that you're baking in something in terms of errors because of different forecast horizons for different firms or problems with the discount rate. So I would just play that up a little bit more if I were you.
Yeah, thank you. And also something to your earlier suggestion. So right now, what I've shown you are just the 1 year ahead forecast errors. So what we've done in the current version is we estimated all these forecasts jointly. And as you pointed out, maybe it's better to estimate them actually individually. So maybe the structure that we chose might not be the right one. So that's something we work at right now. So rather than having like multiple dependent variables at the same time, where we initially, so what I introduced in the slides, thought might be useful because the forecasts could learn from each other, maybe that's actually not that helpful, right? Maybe when you look at these longer leads, we actually see that our forecast errors go up there a little bit for 1 year ahead. So that's something we need to spend much more time on. Thanks for pointing that out, Steve.
Thank you. Thank you.
The next question from Stephen.
Oh, yes. Oliver, that's a pretty fancy house you live in there. Very nice.
Yeah, thank you.
Listen, this is just a technical point. When you write down this residual income model, you're forecasting, say, future RNOA relative to the required return. As you run this model through, it's not actually the future RNOA, it's the future earnings relative to the future book value, okay? Or future operating relative to the future NOA. And that's expected earnings over expected book value, which is different from the expectation of the ratio by the mathematics of a product of expectations. So this is a mistake in Nisman Penman, okay? We run through those graphs with how ROC changes over time, but that is actually the ratio of realized earnings to book value and not the ratio of the expectations. So as you go for 1 year ahead, you're fine, of course, because the denominating book value is the current book value. But as you go extend your horizon, that is a technical problem, which we made, mistake that we made. One way to think about it is to think about what is the expected come dividend earnings over the next 3 or 4 years relative to the current book value. So you get a multi-horizon return on your current book value would be one way of handling that.
So you would always take the same scalar then? So you would take current book value and all, like even when you have earnings 10 years out, it would still scale it by current book value?
Yes, so you'd have expected book earnings for 10 years ahead. You've got to reinvest the dividends, okay? So you've got the come dividend earnings over 10 years relative to the current book value. But that is actually the long run book rate of return on current book value. So you get out of that technical problem and actually you focus on what's important. That actually we think what the payoff is the long run earnings to the current book value. Mm-hmm.
Yeah, thanks for pointing that out. I hadn't thought about that, and we hadn't thought about that yet at all. So yeah, thanks, Steve. That's definitely something we should address.
Okay, Oliver, you can go on. Thanks.
Okay, awesome. Thanks for the questions. So here again, this brings us to the test of our hypothesis 1. So we just start here with the different disaggregation, whether disaggregating more helps us. So basically the baseline here is a level 1 disaggregation, and then we see the slope coefficients of the indicator that we use a level 2 disaggregation, level 3 disaggregation, level 4 disaggregation. And we generally see that, especially for the level 2, we see a large jump in performance. So alpha increases by 2.3% when we move to level 1 to level 3. And that improves even further when we go to level 3 and level 4, but the improvements are not as significant. So if we take these results here at face value, the advice that we would derive for the financial analyst would be, okay, so if you disaggregate, definitely make sure that you disaggregate level 2. You can also go level 3, level 4. There is also a benefit, but the big benefit is really coming from when we move from level 1 disaggregation to level 2 disaggregation. So in the next step, we have this core hypothesis, the core items hypothesis I talked about. So when we try to exclude these items that are non-core, right? And so here we have this indicator that indicates that the model is based only on core items. So it excludes restructuring, discontinued operations, and all of these things. And so here we see that by excluding core items, for the median regression, for the 50th percentile, we see an improvement, but it's pretty small. For all the other regressions, we don't see much evidence. So the implication of that seems to be that, okay, maybe focusing on core items does not bring such a large issue. So the advice for the analyst would be, okay, if you have finite resources, going through the pain of separating non-core from core items might be not that important. So the next step,
Oliver, sorry, there is a nice suggestion by Jeremy. I think that he wants to share with you.
I would appreciate that.
Well, I think you've heard my comment before, but I just think this question of short-term versus long-term is also very closely related to in the short term, how much mean reversion is in earnings or how much noise is in earnings. And some of the recent machine learning research is sort of illustrating how important the Y variables you're selecting in a training sample are. So I think one of the things you're picking up is that, as we look further out, the mean reversion aspect kind of dissipates a little bit, and then our machine learning approaches won't overfit this sort of noise. And so then when we move out of sample, it works better. So I think there are a lot of sort of very practical issues that are spoken to in the machine learning research that you could pull in here and take a more practical view of, if you're going to use machine learning with accounting information, what are the parallels to what they're doing that we have in accounting research? And then I think you'll speak more broadly to, if we want to be doing this in accounting research, how is the data different and how do we have to be careful? Because I think you're sort of illustrating something where a naive implementation of machine learning can lead to actually worse performance. So to me, I think that's what's going on. I would like to know if that's the case, but I just think there are parallels to work on.
So you think that in the context of the core items results in particular?
Yeah, so I guess sorry, I don't want to take your time. So I think in the context of, if you are adding more, two things, if you are looking at short-term versus long-term, there's an amount of noise in how related current earnings are to the next period earnings versus current period to the long-term earnings. And so I think that aspect has a big effect on how machine learning works. The other part is, as you add more variables to the model, right, the less complex to more complex, you have those same things going on, right? Are you adding more noise or are you adding more informative signals? And I think those issues are things that machine learning research has already dealt with, that you could bring in those parallels and illustrate how they affect accounting-based sort of machine learning.
Yeah, thanks, Jeremiah. I like that idea of also bringing that in there. So far we had considered, for example, the core item result as that, maybe there might be something in there. Maybe these discontinued items are not as useless as we would think when we literally take core items at face value and exclude them. But I agree, like, we need to also kind of think more about these alternative considerations that are more statistical in nature to really give the result the discussion it deserves here. Thank you. So I think here's one of our core results. So as we saw in the table for the RNOA alphas, we saw this massive effect that seemed to relate to the interaction between RNOA and forecast horizon. And so given that this is so apparent, even if you just look at the data, we included interaction terms here between an indicator that the model is RSE based, so the baseline here is the model is RNOA based, and an indicator for forecast horizon. So 5 years out and 10 years out, again, the baseline would be that the model only forecasts 1 year out. So and you can interpret these results here as follows. So if we only forecast 1 year ahead, RSE-based models do way better than RNOA-based models, in particular by alpha is 9.3% higher. RNOA-based models perform terribly if you only forecast 1 year ahead and then apply a terminal value. However, once you start going out further, and that's something we learned while we were working at the results, once you start going out further, then RNOA-based models really start to shine. So once you go 5 years out already, RNOA-based models handily outperform RSE-based models by more than 2% of alpha. And then that incremental performance improves even further when you go out even further out in the future here by 10 years. So the direct advice to the analyst would be, well, so if you only want to forecast for the short term, use RSE-based models. But if you forecast for the long term, then you really should use RNOA-based models. And that also carries over here in the next finding, which is about forecast horizon. So here we have the indicator for forecast horizon for lead 5 and lead 10. And there we see that All right, increasing the forecast horizon really improves our model performance. So here the advice for the analysts would be really try to forecast longer in the future. And this is first, to our knowledge at least, the first empirical evidence that actually speaks to that. So if you combine that, oh, please.
There is another question from Stephen.
Yeah, so sorry to interrupt you. You got short time here. Just a short question. For a very long horizon, the survivorship bias is huge. Okay, how do you deal with that?
Yeah, so I guess when we have these long horizons, we make sure that our sample is the same across all these different firms. So for example, even when we only forecast 1 year out, we make sure that we only use these observations where we also can estimate the model for longer horizons. But as you point out, we cannot do that, for example, for observations that are only in existence for 1 year. So in this case, we have survivorship bias because we cannot use these observations to estimate the model. But then when we apply the model for out of sample forecasting, we apply it to all firms. So for out of sample forecast, we don't have survivorship bias. So survivorship bias here would work against us because it applies only in our estimation period. And there it would work against our model being useful for these firms that will go bankrupt soon. But then our out of sample performance, it doesn't apply because again, it's everything observed right away. Thanks, Stephen. All right, so forecast horizon. So let's interpret this result in conjunction with the one on hypothesis 3. So we saw that for short horizon, our ROCE does better, but we saw for long horizon, our RNOA does better. But now we also see that we really should go in the long run. That gives us large performance improvements. For example, for our lead 10 indicator, an improvement of alpha of 13.3%. So if you take those together, I think then the general advice would be forecast far in the future and use RNOA-based models because these work in conjunction with each other. All right, then we also look at historical information, so whether using more lags of financial statements is useful. So the baseline here is just using the current financial statements. And here we see that adding another year of financial statement data helps us in some sense. So we see that we improve our median performance and the performance on the 75th percentile and the 95th percentile. But for all the others, it's not statistically significant. And when we go further, when we use even further information further in the back, so for example, lag 3, lag 5, then we don't see any significant improvements anymore. So the advice for the analyst here would be, well, so if you use information, you're using the current financial statements is probably fine. Maybe you want to use one additional year of information, but going any further than that won't provide you large benefits. Sarah,
Oliver, a quick comment from Jung.
Please, Jung.
Hi, Oliver. I really like the results, or it's a puzzle you created that the ROCA and CE and an RNOA has a different kind of horizon results. One potential explanation is there's some binding constraints. So for ROCE, I can think about is that financing contracts may have a different duration, but usually it's between 5 and 10 years. So that potentially you can just maybe for a subsample, take a look at financing debt contracts, the length of the contract, and mainly you want to focus on contracts with more binding fixed rates and binding kind of covenants to see how does that kind of correspond to your horizon results for ROCE. But for RNOA, I can think about a product life cycle, like a PC versus smartphone usually spends more than 10 years before that product or technology dies out. So that will relate to more long-term, less noisy signal in terms of profitability.
Yeah, I see where you're going. So like the hypothesis would be that because of these financing constraints, that's why RC does so well relative to RNOA in the short run, right? Yeah, that's we haven't thought about that yet, but that's a great idea. We'll look into that. Thank you.
Yeah, I think that's a very cool result.
All right, so here that is basically the core of our paper. In the remaining tests, we want to make sure that our results here are also actually implementable in real trades. So one concern would be that we would be really good at identifying firms that do poorly, but really bad at identifying firms that do well. So in this case, our performance should derive only from the short side of things. But we all know that shorting stocks in many cases is actually not that easy, right? Because there are lots of limits to arbitrage here. But fortunately, we can assure you our performance here nearly completely derives from the long side. So you see here the cumulative return over time in logs. So to make it to make the interpretation to allow us to interpret our results in proportion. And here we see that when you compare it to the market, our long side of our portfolio performs phenomenally well, and our short side of the portfolio performs a bit worse than the market, but not considerably much. So this gives us comfort here that we could actually implement our results in actual trades. Then we also compare it to other estimators. So we want to check whether our performance really derives from us using these deep learning algorithms to estimate nonlinearities, or whether it's just the independent variable selection here. But these results here generally speak to that it's really deriving from this estimation of nonlinearities, because when we estimate the same model using exactly the same independent variables, using OLS for value-weighted or equal-weighted returns, or using LAD, we don't get any significant alphas. So the performance really seems to be driven by the estimation of nonlinearities here. Then we also,
4 minutes left. 4 minutes left.
Thank you. So we also check some cross-sectional variation to identify the firms for which consideration of nonlinearities is very important. And here we just use some cross-sectional regression to determine here fixed effects. So we regress future returns on our value to price ratio rank in deciles. And then we also interact that with several types of firms that we're interested in, because we suspect that nonlinearities might be important for them. And all the main effects and other controls are also included in this regression. So we see that consideration of nonlinearities is especially important for small firms, for firms that are making a loss, for financial distressed firms, and also for technology firms, right? So exactly, I think this yields a bit of evidence here that our results are important exactly for the firms where we would expect nonlinearities to matter a lot. So in conclusion, prior literature generally struggles to estimate structural valuation models because of the presence of nonlinearities. But advances in computing power and machine learning at the same time allow us to use a very powerful tool, and that is deep learning. Again, probably the most powerful machine learning algorithm there is right now. And so we use deep learning to estimate the information dynamics in Nissim and Penman to forecast future profitability and derive at value estimates. And we find that using this methodology with deep learning, the structural valuation framework applied, used within a deep learning context, yields more accurate out of sample ROC and RNOA-based predictions, and also yields excess returns. And the most important part in our mind of our paper are the implications for financial statement analysis. So the performance derives from greater disaggregation and long horizon forecasts of operating activities, but not so much from a focus on historical information or on core items, and also some policy implications. So maybe we shouldn't interpret the lack of a linear association between market and several accounting variables as evidence for that accounting doesn't matter, that accounting is useless, as some authors have interpreted these relations in the past. Maybe there is just the presence of nonlinearities going on here. So maybe we would want to look into this a little bit more. So basically our paper opens up a new avenue of future research, hopefully, by showing that. And so here also a slide that makes a little bit of advertising here for the next presentation of the accounting design project. So next week, February 3rd, from 11 to 12 a.m., Stephen Penman will actually present in the accounting design project, and he'll present the paper, the accruals cash flow relation, and the evaluation of accrual accounting. So with that, I want to thank you so much for all these wonderful comments and for your attention and for being here. We have a lot of great comments that we got from you guys, and we have a lot of work to do. Thank you so much. It will make the paper much better.
Thanks, Oliver. It was a great presentation, and I want also to thank Haifeng for the first presentation. It was really great. Before stopping, I want to tell Oliver that there is another question also from Jeremiah. So we have still 30 seconds probably to conclude if you want to share. Okay.
Oh, I just was wondering if you can understand more of the nonlinearity. Now that you've sort of identified that's what matters, I would just like to sort of know a little more about it as well.
Yeah, I agree. I think that's super interesting, especially in the context of, thinking about the relation between market and accounting variables. Totally agree.
Thanks again for all of you. It was a great session. See you next Wednesday.
Thank you, everyone. See you next Wednesday.
Thank you,
everyone.
Bye.
Thank you. See you next Wednesday.